Welcome, everyone, to Name Confidential Live.
Welcome, everybody, to Name Confidential Live. My name is Ben Fox. I'm the host today, and this is season two, episode number 32. And our guest today is Bruce Bryce, an advisor with Ash Creek Financial. So, Bruce, welcome here.
Thank you. It's going to be awesome. I'm excited.
Oh yeah, we get the Friday before Labor Day weekend, so I always feel like I have the fun ones right before extended weekend or after an extended weekend. So let's
Yeah.
go. We're going to jump over here, first cover the name exposure index like we always do on the show. As a reminder, the name exposure index represents the average equity exposure to the US equity markets reported by our members. Um, let's see. So last week, looking at this, it was 98.15. We went down a little bit, 92.94. I'm not surprised to see it up there at the 90s. This week we saw the SP 500 reach a new high. What was this? 6,500, I believe, on after yesterday. So I don't know. Like I know you aren't a name member, so you don't um report to the name exposure index. But do you have any thoughts on the index or anything you want to share?
No, it's super intriguing, something that you should probably be looking into and checking out. We do use some strategies from name members, so it's good to know what the broad um, overview of everybody, what everybody's thinking. But it's really cool that you guys do this. This is kind of new to me.
Yeah, we updated we submit them every Wednesday. So I think we see them Wednesday evening, the new number for the week. And I haven't paid as much attention to it until I started doing Name Confidential. And they're like, hey, you got to look at this every week. We submit to it at Scarecrow, but I never actually looked at it until I joined the Name Confidential crew. Also want to hop up over here and talk a little bit about our Outlook conference that's coming up this November in Chicago. So it's going to be November 3rd and 4th. We have a great speaker lineup. I know Jim Bianco is huge. You got some other big names here, Sean Bailey as well. Um, and let's see what I was going to go down. Oh, the agenda's up here. I can kind of go through the conference agenda. So yeah, everybody quick rundown. Everybody usually comes in on that Sunday, and like it says right here, go have your first drink, meet all the members there. Name Outlook tends to be a little bit more tighter knit of the group that goes there. We do have our bigger conference on common knowledge in May, late April, May time frame. But this one it's short, sweet, and you get just jam-packed with a ton of good information and kind of not a lot of fat, I guess you could say, kind of in between that. Um, so yeah, mo big stuff that happens on Monday. That's when you have a majority of it. Tuesday's kind of a little bit faster of a day. We do go until about 4:30, but you don't have the ending event that day. So you're in Monday full day, in Tuesday until about the end of work day, and then you're boom. You're either staying there, some people like to stay, or you're hopping back on a plane and getting back home. So it can be quick and sweet. Um, I don't know about you, but I know we've talked a few times. I think you need to get down there. So I'm also gonna promote this internally through Name Confidential to you to say like, hey, let's meet up there. It's a short conference. As we'll kind of learn later on, you're familiar with a lot of the name members and some of the strategies that some of the members have there, and it'd just be, I think, a good idea to check it out and meet some of us in person too. But yeah, if you want any more information on that, I have the link up here, so you can go to the name website, and when you go to our conferences, just pop down on Outlook. Now on to the fun stuff. So now Bruce gets to talk. So I don't know if you want to get up the pages that you were going to share, but we can kind of start off a little bit about your investment philosophy and anything you want to share along those lines.
Sure. Yeah, I mean, I started in the industry in 2004 and was introduced to active management pretty early on. And our philosophy has evolved a little bit over time. but it's a values based, philosophy. We start with we want to offer more in value than we charge in compensation. We say that a lot, and we don't. It's not just like a slogan or a value thing. We think about it all the time. Like, are we offering enough value to our clients for what we receive? And then we want to basically audit portfolios is what we do. And when clients come in, and we want to make sure they're getting enough reward for their risk. So sometimes I'm sitting down with a client and they're getting plenty of reward for their risk and they're in an awesome portfolio. But actually, that's not very often. I just say sometimes. But I'm not afraid to tell them that they have a pretty good portfolio. But a lot of times it's, hey, you're in something that's averaged like 6, 7%, and it has 50, 60% drawdowns and 5, 6, 7 year recovery times. And part of our philosophy is thinking about that. It's not just an average or even a total return, but what is the pain like? What does the journey look like? So if you're down, only 10% in a really bad market, but it takes you 5, 6 years to recover, that's still not good. If you're down 40, like on a Pro Chaser max drawdown, but you're even very, very quickly, then that's a good thing if the client wants to take that kind of risk and we walk them down that path. So we think about risk a little bit differently than standard deviation. We look at upside versus downside standard deviation. We don't look at beta a whole lot because at least with Pro Chaser, because it kind of gets skewed when there's some shorting and some leverage involved. So what we really look at is underwater analysis. We want to make sure the data is clean, and we love GIPS verification. So we that's one reason why we love your strategy, Ben. But our our philosophy also is that we always say this, that the largest drawdown is probably somewhere in the future. And probably one of my favorite things to say to a client is, I'm going to show you all these max drawdowns and averages, but I promise you somewhere out in the future, there's going to be a pretty deep drawdown, one that this manager hasn't seen before. And that's why, diversification is always going to be one of the number one things you do with larger portfolios. You just have to do it. So big part of what we do is diversify philosophies. We don't asset allocate. One of your members, Dina Fliss, taught us when we were with Global View, when we were affiliated with them, that when there's a bear market, all the asset classes correlate. Everything correlates, everything goes down. Doesn't matter if it's small cap, large cap. If you have some foreign stuff, a global recession, everything tends to go down. Sometimes bonds will work out and sometimes they won't. If you look at 2022, it didn't work out for bonds in a bad stock market. So we want, yeah, non-correlating different philosophies when we look at active management. And we do hold some passive as well, but we're strong proponents of being able to be nimble and liquid. So that's kind of in a nutshell our overall kind of philosophy.
How many active managers or strategies do you guys have at Ash Creek? And then how many do you personally use? And why is there a difference, let's say, two between the gap?
Yeah, I probably use 15 personally. A lot of them kind of in and out of my own account, beta testing with my own money to make sure everything's trading correctly. And when I do research, and I usually will run it in my own account before we
Mhm.
head over to clients' accounts, because it's kind of my job to teach the other 10 advisors what I'm doing, and then they're free to kind of allocate how they want, but they look to me for guidance on that. So our advisors probably use 5 managers or less. We do have mutual funds and ETFs we like, but they're run by managers. A lot of managers are creating 40 acts to not get shadow traded or for other reasons, or ETFs to have some more tax efficiency. So we're not just using SMAs or third-party SMAs. We're using a kind of a basket of everything. We're kind of have a true UMA platform, but not a ton of different strategies. We've been using Scarecrow for over a decade, and kind of diversified with a couple of new managers over the years, but we'll probably add a manager every like 1 to 3 years or something, like in a major way.
Yeah. This is a question I didn't tell you I was going to ask, but I just thought of it here. When do
All right.
you when do you know when to, I guess, fire a manager?
It's a good question. And I get that one from clients and I always tell them, hey, that's an awesome question. Um, when they don't pick up the phone and explain to me what's going on, when the communication it just goes away. I like having communication with you, Ben, and other managers we deal with. That's not the only reason. I mean, if the performance is awesome and you're not picking up the phone, I guess I won't complain too much. Exceeding the max drawdown is kind of a red flag, but we're gonna want to have communication on why that is and if we feel like it's going to bounce back quick. And we've had those conversations during COVID and other kind of scary times. We talk about it and then we're able to go back to our clients and say, we talked to the manager, this thing's going to rip back. The recovery time is good. Their system's not broken. It's not like their math doesn't work anymore. We know it sucks. So we don't try to blow smoke to our clients. When it sucks, we tell them it sucks. They go, hey, what's going on with my account? I'll say it sucks right now. You're getting killed. And they're like, whoa, like I thought you were gonna sugarcoat it, and I don't do that. So I think our clients appreciate that. Just helps to go with building trust with them. Another reason to fire a manager, or at least to look at it, is when they don't have like a succession plan. We have a couple managers where they're the brains behind it. They're making the trades based on how they feel about things, and it's not 100% quant driven, so that's a little bit scary. Or when they pass it on to somebody else, it's like a mutual fund, an actively managed mutual fund. You can look up on Y charts, which we use a lot of. They might have a 40-year history, but the person managing the fund has been there for 6 years, and that's makes the data irrelevant to me if it's an active manager. So whenever there's a trading of the guard, like when Len gave everything to Ben, it was like, okay, who's this Ben guy?
Yeah.
And he's the kid. He's the kid. And we watched that transition happen and it was super successful. So there's some red flags. We haven't had to fire too many managers. I would say the ones we did have to fire had a lot of back testing that they rekeyed a bunch of times.
Mhm.
So there's a couple firms that have done that and we just couldn't trust their back data anymore. And we wanted to use real data. So a lot of
Do
these,
you have a limit that you normally want to see? Like if you're looking at a strategy, like I want to see this many years, or are you comfortable looking at the back tested data and being fairly confident with it, or is it a blend of both of that?
I don't really like back tested data almost at all anymore. I used to, I'll look at it, but it doesn't hold a lot of weight with me. We're obviously not going to show it to clients. But the beauty about the last few years though is, and COVID was a huge blessing, was how are these managers going to act during COVID?
Mhm.
And 2022 was an awesome
Yep.
year to judge a manager, and so was 2023. You had a worst year since '08, and then you had an awesome year. So if you don't have '08 data, you still have 2022, 2023. This year you have the tariff thing. How did you manage through that? If you held through it, awesome. You're in a great spot. If you sold at the bottom and you haven't gotten back in yet, then you lose some trust with me.
Mhm.
Um, it's not a complete deal breaker, but again, that's why you diversify managers is sometimes they're going to get it wrong. I could think of one that got it wrong and was a little flat over the last couple of years, and then they've just crushed it this year. And you know, wish we weren't a little too antsy and fired them on too many assets, probably. But we're still learning in that regard. I think you just have to trust the process and not trust the back data. I mean, you have to have data, you have to have history to make a decision. It's going to rhyme with the future. But for me, I like to dive in deep and like, how does your strategy run? And I need to know the philosophy behind it because if I can grasp that and trust that, then when it hits hard times, then I'll be okay. If I'm just relying on past data, it's really hard to trust something.
Yeah.
So
What I know on the other side, it's always, it was good to, like, it was kind of funny that we launched another strategy in the middle of 2020. But then we were able to have 2022. It's, a lot of people that I speak to there was one advisor way back when I was starting in the industry. He's like, I will not invest in a strategy until it has at least 3 years of data, and one of those has to have at least some kind of bear market or sideways conditions in it. And there was a period where that wasn't really happening. So he wasn't he wasn't looking at strategies. He's like, well, people can you can be an active strategy and you can make money in a bull market just being in the market. I want to see what you really do when things kind of hit the fan, and how
Right.
your strategy goes through and manages through that. So
Yeah, I would tend to agree with that. And the last couple of years have been awesome for
yeah.
that. So people had a chance to prove themselves. If they've started after the tariffs recovered this year, it's a little difficult to know. I'm
hmm
gonna wait. I'm gonna wait a little while. Um, and yeah, I think it makes perfect sense, like that gentleman was saying, to wait a little bit and see. I actually watched a strategy from 2014 up until 2 years ago before I started using it. I mean, so it's just kind of depends. Took me a long time to warm up to it.
Is there anything that you want to share to kind of along like the philosophy lines?
Yeah, I can share my screen here real quick. If it will allow me to. How does this look?
Yeah, I can see it. Yeah, in the white charts. Yep.
You can see this Y charts. So this is super simplistic, not a recommendation. It's not a model of ours. It's just research. So this research tells me, what if I take Ben's strategy, Pro Chaser, and I blend it with another strategy that trades on a different index, the S&P instead of the NASDAQ. And first of all, what kind of pops out to me is I know that the drawdown is quite a bit less than Scarecrow by itself, and the return is pretty good. It's about, it's 19 and a half. But on Y charts, we get a correlation kind of analysis. And I've actually done this with 180 positions on here with a guy's stock portfolio from
Right.
Merrill Lynch. And it was pretty interesting to see how much his stocks all correlated. But obviously, any strategy with itself correlates at 100%. But when we move these together, they correlate 40% of the time. And both these strategies move up and to the right on the graph, like they're making money, which is obvious. You want that. You want to be making money. So the fact that they're 40% correlated is, we feel like, is low enough to justify blending them together. So when we kind of audit portfolios, we'll see clients that are in like 5 growth funds and they're all holding the usual suspects with NVIDIA, Apple, Netflix, Facebook, the Mag 7, and they correlate like 98% of the time. And we're like, well, why are you holding 98% correlation? Why don't you just pick the one that's done the best? And then you start looking at expense ratio probably last. Um, some people look at that first. I think that's wrong. I'm sure everyone here has experienced a CPA that just wants to point out cost all the time.
Yeah.
But yeah, we just kind of do analysis like that. And then another part of our philosophy, I'm going to skip over to another browser here. Can you see these circles here?
Yes, yes, I can.
So we help a lot of people retire. So when we think about retirement, it's just, how do we allocate these strategies? Scarecrow's pretty aggressive in the short term, as we've seen pretty sharp drawdowns in a day. And we point those out to clients, but we put them in a 7 year bucket. In other words, we don't need this money for 7 years. We're going to let it grow. That's the long term bucket. The 1 to 3 year bucket is basically going to be money markets, treasuries. We can ladder out some CDs or bonds. We don't really love bonds. We use different instruments, but you basically can't lose in that 1 to 3 year. And there's a range because it depends on the asset size and how much income they're taking. And then 3 to 7 years is more strategic in nature. You won't find tons of tactical in there, but there will be active managers that fit that. And here's kind of our universe. Not that we use it all in every account, but Scarecrow's right up there. The 2x aggressive growth tactical, number one, right there. And it's a big part of what we do. It's a big part of our core equity. And this is what I mean by diversifying different philosophies. And there's some cool new stuff out there that many of you are probably aware of when it comes to what you can do as an advisor. You can do some structured notes and some buffered ETFs that kind of act similar to that in an advisory platform where you don't have to work with a broker dealer to do that kind of thing anymore.
Mm.
But that's kind of our list of things we do. These alternative asset classes, we build out. We actually have an ETF model where we don't have to go into interval funds. So interval funds is getting very popular with advisors. I don't like them. I don't like the lack of liquidity. We do use a few, but sparingly. And kind of my view on private credit and some of those interval funds is they possibly could be in a bubble. We're seeing like the Harvard, the Yale endowment
Mm.
that has been very successful for a long time. We're seeing them exit those types of strategies, and the big institutional money is starting to sell private credit, private equity, and they're getting a little nervous. And so we don't touch a lot of it, but we want to be liquid, so we use a lot of ETFs, and then managers like yourselves, Ben, to build it out, for us so we can get back to planning and spending time with our client. So
What what is the
the
biggest thing that you feel like you've learned just in using active management since you started?
biggest thing that I've learned, wow, yeah, that wasn't on the list.
That was
The single
the next
biggest,
one will be, I promise.
um,
I mean, is there anything, that maybe before learning about active management, or maybe something that you heard that wasn't necessarily true about it, that you realized after diving into it? Or did you go into active pretty early in your career?
fairly early. I was just selling American funds like any other, advisor that had access to like through the broker dealer side before I became a fiduciary. And '08 happened, didn't have a ton of clients then, but we were watching crazy stuff on the TV as far as the losses were just crazy every day. Um, for a month, October of '08 was probably what changed me by quite a bit. And then my diversification philosophy comes from picking a mutual fund that had a great history through '08, and it failed during VIX-Mageddon 2018 when it basically blew up. It lost 98% in kind of a day. So I don't know if anybody remembers that VIX-Mageddon, but they had managed future, or they had options on futures like way out of the money, and it should have never triggered, but it did. And it was, luckily we were allocated correctly, 10 to 15% on the high side for that fund in any given portfolio. But that PTSD from that moment, and I had clients that were pretty emotional that had lost, $100,000 in one day, on their $1 million account, and they were obviously upset, and that changed my view on diversification. I want to make sure that I continue to diversify, and I still will defend myself to the holding that I didn't go over 15% on that particular fund. But the name of the fund was Preservation and Growth, and there was a class action on it because of the preservation word, right? So
Yeah.
they didn't have a fillable PDF, but they had a packet for the class action. And I filled it all out for all 52 clients that were in that, and they got their $3 back or whatever. Those are awful, and those will change the way you think, and that's why I think this way now. Um, Kind of another thing that really kind of resonates with me is the psychological part of investing, where the clients have greed and fear, right? I have learned to get really excited when Scarecrow is down about 30%, 20 to 30, because
Glad somebody's excited. No, I was
I
kidding.
do. No, and I'm serious. Like I get excited because I got new cash to deploy, and that's generally when I like to add. And I have clients that need to add. And I get a little nervous when it's halfway through the year and it's up 65 or
Mhm.
70. I'm getting a little nervous to add. Not that I'm gonna wait forever to add to it, but it's a great time to take some profit when any strategy is up 60, 70, 80%. So I try to kind of think opposite of what my client. I have a couple of clients that will call and want to manually go to cash and override the managers. And when they call, that's confirmation to me that I'm going to add. And I'll tell them that to their face. I have make call me a jerk or whatever, but I've done it where they've called, I get me the cash. It's this is going to happen and the market's going to keep going. And I'm like, hey, last time you called, this was like near to the bottom. And they're like, I don't care. I went out. And I'm like, okay, I'm going in then. Um, if one or two of them call and crows down 30, it's a great time to add. And it's worked out for me over and over and over on my personal investing. So I think that if people are taught these types of strategies, active managed strategies correctly, and you understand the philosophy, then you can talk to your clients correctly about it. So this year, we had the tariffs. The tariffs caused a bear market for what, a couple of days. It was negative 20. The technical, definition of the bear market at 20%, and it was a great time to add. And we didn't have too many nervous clients. They've been taught, really well that that's a great time to go ahead and deploy more money if you have it. And so that I mean, I've just learned a lot over the years through the school of hard knocks, I guess.
Yeah, the emotional side that goes into investing is something I've been paying attention to a lot over the last few years. And as you were talking, I was thinking about I had a few advisors or clients that were saying like, hey, this is Liberation Day. Like we're gonna sit out. We're gonna go to cash. And I think it was later, what was it, like Wednesday the following week? There was that like one of the I think it was the biggest NASDAQ 100 day. Um and it's just I like something that Len had always told me is it can change fast. And that goes both ways. And I remember thinking at the time, I'm like, oh man, we've had some good ones, but I just feel like we're just missing right now. And then you catch a day like that, and it's a completely different world on the other side almost.
Right.
Now of course that can go both ways. If you're on the wrong side on a day like that, that can push you really far under. But yeah,
And
the emotional side, I've had right before the bottom a lot of that. That's when I feel like I hear the most from clients, which is that was interesting to kind of hear you say that too. And as advisors managing through and helping even your clients managing through those emotions that come with that. Like I jokingly tell people we're financial therapists at a certain point in our business, when we're going
right.
through that kind of stuff. So
Right. I would say, yeah, if you could teach yourself to get excited about, I mean, we get more referrals in a bad market than a good market. When in a good market, nobody wants to leave their current
right.
advisor. Their current advisor is the hero that year. But in a bad market, people are a little uncomfortable. That's when we usually grow the most. 2020 was awesome for us. We grew like crazy in 2020. But like this year, only a handful of clients even called me during the tariffs worried. And I remind they're retirees. So I remind them you're down, 8%, 10% overall on your portfolio. Most of that is Ben Fox's fault, but it's on the 7 year money.
Yeah.
You know what I mean? You got 7 years, you got 1 to 3 years making 4.5%, and it hasn't moved. It hasn't gone down. Your dividend stock manager is positive for the year because for the most part, those defensive stocks did incredible through that drawdown and better than I thought they would do. And plus you get your dividends every month. So that's your 3 to 7 year bucket. It was a little bit more stable. Some stuff was down for sure, but when they understand the time frames of where we're putting their money, it gave them a ton of clarity and a peace of mind. They were just like, oh yeah, that's right. And you're telling me that's why it's down and it's not, my income's fine. I'm like, yeah, you got 2 years of income still left over or 2.5 years of income.
Yeah.
We could weather this for a while before it's gonna really do anything detrimental to your income. So I think that's a good one of the good ways to look at it. This has kind of been a work in progress for us. We're trying to, I don't know if perfect it, we'll be nimble with it, but we like how we set this up.
Yeah, I think there's a lot of value in like you said, kind of doing a deeper dive into the managers, understanding really how they fit, but also being open to as you learn more or as things, as you get more information on it, like making some adjustments to later on and all that. So
Right. I would say
looks like
just
looks like you got a good plan in place, philosophy behind it.
yeah, it comes to just asking a lot of questions to the clients too. Is a client will say, "Hey, I have 100,000. How would you invest it?" And I go, I don't know. Like, what's the job of this money? We talk about that a lot. Like, why would you hire me, or why would you hire your money to go invest in this? And they don't think about that, but I think about it all the time. Like, why am I hiring my money to buy ice cream? Because I love ice cream and it makes me happy. So it's money well spent. But what do you want to do with that 100,000? What's its purpose? And if it's to grow it like crazy and you're not going to touch it, let's put it all in the 7 year bucket. If you're going to do a remodel at the end of the year, that's not invested at all. Keep it in your bank. So it's what's the job of the money? And if we ask those kind of questions, and then we can solve the problems and put them in the correct allocation, and then you remind them of that when, man, I lost a lot of money this month. Yeah, you're in a 7 year bucket. If you remember, just kind of zoom out on the chart. Don't look at this month. Look at the last 5 years, 7 years of what this thing has done. And if you got more money, add to it.
Yeah, it was reminding me of, I think it was a quote, and it might have even been somewhat along the lines of the quote you were gonna do later when I asked you about your favorite quote, but says like you go to work every day, so should your money, or something along those lines. And we heard that, or Len used that in our business all the time when he would talk to people. He's like, so, if you're going to work, why shouldn't your money, um, go to work for you as well? And as you're saying, that money may have like a different job. Some might be I would guess the entrepreneur would be like crow chaser, kind of
Yeah,
going
yeah.
out there trying to be a little bit more aggressive, a little bit more risk with going that route. Whereas, if you're more conservative, you might be in fast food, getting something really, minimal but consistent. So yeah, it's interesting.
Yeah, I mean, risk is everywhere. It's in being too conservative. So, um, an advisor's job is to help the client know how much and where to take risk. I mean, and if we could get really good at that, you'll have a very successful business because a lot of clients have to talk them into being a little bit more risky because they're scared. But inflation's high and it's going to probably remain at least elevated for a long time. We haven't had to think about, inflation up until a couple of years ago. We just, it was almost zero for a long time. But now we have to think about taking a little bit more risk because not taking risk is a risk.
Yeah, I think it's on the topic of that, one thing that at least I've noticed is a lot of people, even as you go through like the risk tolerance questionnaires and asking those questions, initially don't really know where their risk actually is or the risk tolerance is. I've had people as they go on like, oh yeah, I'm very moderate, but as you learn later on, like actually you're more aggressive than you think. And I've had others that are like, yeah, no, I'm aggressive, and then you like actually you're you're pretty conservative when you dive back into it. It's just interesting, in this industry, how much you can learn through like a deeper dive with your clients.
Yep, lots of personalities and takes a little bit of experience to jive with that. That's why I kind of feel like AI doesn't have the upper hand on us yet, and it's going to be my friend, I think, for several years until it turns on me and becomes as good as what I do when it comes to reading people and allocating them correctly. Hopefully it gives me 5, 10 years before it turns on me. But right now we're friends, and I think people want to talk to a real person anyway. But yeah, it's just a fun business. I enjoy getting to know the different personalities and different people and helping them understand. And sometimes their view of risk has been in a passive world, which this is the name this is the name video, right? So we don't like
Right.
passive over here. So they're used to passive, they're used to no protection, they're used to no move, no forethought on what are we gonna do. No, there's no philosophy. It's just hold that stock market and hold on for dear life. And that's what they're used to. And so that's why I feel like most clients could probably tolerate more risk if there was somebody behind the wheel.
Mhm. That's good. I like that. Um, I'm looking at the time. I'll keep it short here. The last one would be, do you have any thoughts on where you see the market going for the end of the year? Or if you have nothing there, do you have another quote? Or is there a quote that you had outside of the one I kind of shared?
I mean, I should kind of shout it earlier that I think the
Yeah.
largest drawdown is always in the future. And I can't remember where I heard it. I don't want to claim that I coined that. But it's just, yeah, it's something good to think about. Um, a funny one by Jack Handy, which is a little inappropriate. He does old 70s Saturday Night Live quotes, if you remember those from back then. It's a really short line that he has about money. He says, I'd rather be rich than stupid.
Yeah.
But I've met a lot of rich, stupid people, so it doesn't apply. But I really like that one. I really like, you're hiring your money to do a job, whether you know it or not. And our clients, they work so hard for their money, and I want to teach them not to be a slave to their money. Like it's not your job to please money and to go get, work super hard just to get a little bit of money. That's not your purpose in life. Your purpose is to get a little bit of excess and then make that money work for you and work hard for you and in a smart way. And eventually you've hired that money to take over your job and, you know, and you flip the tables on it. So let's not be slaves to money. Let's make money our slave.
It's like having a kid. Like you're taking care of the kid, and then when you get older, then the kid comes back and starts taking care of you.
Oh man, I don't want to live that long.
Well, perfect. Any other thoughts or anything you want to share?
No, I'm good. This was fun. I'll probably have to jump on and watch the future ones. I'm excited to see who else you interview, and we'll have to take a look at coming out to a conference and getting to know some other managers as well. I love due diligence. I've researched hundreds and hundreds of managers over my career, and it's kind of a hobby of mine.
Yeah, I mean, you would fit right in. I can tell you that much. If you came over there, you'd fit right in. You could sit right by me if you need to. I could open up a seat. So, yeah. Well, Bruce, I want to thank you for coming on here and sharing your knowledge and looking forward to talking to you again soon.
Awesome. Thanks, Ben.
All right, thank you. You have a good week.